see what else they can do for you. Richard, Catherine, it's all yours.
Awesome. Thank you so much, Dr. Stubbs, for that really fun introduction. We've really enjoyed this series. Make sure, if you haven't listened to the credit workshop that we did and the budgeting workshop, the spending plan, that you go back and access those. But we're excited to have you live here today and doing the introduction to home ownership with Catherine and myself. And so without further ado, I'm going to turn it over to the talented Catherine Hubbard to walk us through some housekeeping items before we dive into the series.
Awesome. Thank you, Richard and Dr. Stubbs. I'm so excited to be in the background here. So I'll be in the chat box with you guys. You'll see that Mr. Stubbs is sharing resources in there. So whenever you guys have questions, feel free to put them in the chat box. You should be able to get to that. There should be like purple arrows down in the bottom of your screen that you click it and it gives you the chat option. It'll give you the participants, and then there should be a content button in there where you can reach our PowerPoint presentation for download and some other resources Richard will go through. If you're having any issues getting those, feel free to shoot us an email. We'd be more than happy to email them directly to you. During the session, we'll also be asking you guys to raise your hands. So down at the bottom, you should see a little person with their hand coming up. You can click that and it'll bring your hand up so we can see, as Richard's asking, has anyone ever done X or Y? We can have that interaction. And then we'll also have 3 poll questions throughout the class. They'll pop up on the screen, and then a little chat box will pop up for you to pick your answer. And then if you guys are having any issues, just put them in the chat box and I'll do my best to help figure them out.
Awesome. Thank you, Catherine. So let's dive in with our agenda for today. And our agenda really is about buying a house. And our goal is not to get you to buy a house, but to make sure, if your goal is to buy a house, that you're a successful homeowner. We're going to start by talking about the steps that that you would go through to become a homeowner. So we're going to give you that map to homeownership. We're going to give you some clues, 2 places to start where you could be getting started on your path to homeownership. Then we're going to talk about the all-important rule of 3, and I'll elaborate more on that in a second. And then we'll finish with figuring out how much house you can afford. So affordability is a really big thing we're going to leave you with today. So I want everybody who's on the webinar to raise their hand. Catherine just showed us how. Raise their hand electronically down below if this sounds like a pretty good agenda for the next 35 minutes or so. Awesome, awesome. All right. I'm hearing some hands going up. That's great. I appreciate that. All right, so let's dive right in, y'all. The first thing we want to do is ask you this question, and it should pop up in the poll as I'm doing it. You're going to put A, B, C, or D. So what should be your first step in the home buying process? A, setting a budget. B, getting pre-approved. C, shopping for a house. Or D, hiring a realtor. So how should you get started? What should be your first step? And if you're not, just guess, because we will not grade you on these. Catherine, did the poll open okay?
It did, and people are bouncing around with their answers, so I love that people know they can change them around. So
oh, good. Good.
Perfect. All righty. It looks like we have everybody clicked in, so I'm going to show them the responses. And just so you know, Richard, we've got the top response is setting a budget, followed by getting pre-approved, and then hiring a realtor. So no one thought their first step should be shopping for a house.
Okay, fair enough. That's awesome. So can I unveil the right answer?
Yes, sir. Go for it.
Perfect. All right. So it sounds like the majority got it right and said setting a budget. And this is really the point of this, y'all, is to figure out or start with what you can afford. That really is the starting point, because a bank's going to pre-approve you, and a pre-approval is like a financial institution just taking a quick snapshot of your finances to tell you how much they'd be willing up to lend you. But they never make your mortgage payment. So you need to make sure you know how much you can afford and how comfortable you would be with that payment before you get going on all these other steps, which are all great steps in the home buying process. But the key is the first step. Awesome. So let me walk you through the steps. So we just did budgeting, talked about, what can I afford monthly? What can I afford on the purchase price house? We want to start there. Number 2 is with your credit report. So we want you to go to annualcreditreport.com, pull all 3 copies of your credit report for free. Make sure there are no errors on it. Make sure everything is being reported accurately. And the number one reason why folks are not purchasing homes, we still hear, there's a great selection out there. Interest rates are at an all-time low. The number one thing keeping folks from purchasing a home is credit. And so we want you to get started on that. It is not something that can be fixed overnight, regardless of what the signs say on the side of the road. I cannot erase bad credit. I can build, rebuild, or manage credit. And so we want to do that early in our home buying process. Once we've got those 2 steps down, now we're ready to go get pre-approved. We're ready to talk to a financial institution and have them take a snapshot of our finances and pre-approve us for an amount up to what we would like to purchase. That lets us know, it lets the realtor that we choose, it lets us know, and it lets a potential seller know that this person is serious. Then we're ready to hire a realtor. One of the biggest complaints we hear from folks is, my realtor, I tell them I want to live on the west side and they still keep showing me stuff on the east side. Or I told them my budget was $100,000 and they're showing me things at $200,000. And one of the suggestions we have is, if you don't like your realtor, you don't trust them, they're not working for you, go get another one. The reality is you really need to trust the realtor because their job is to guide you through this whole process. And if you're not sure they have your best interests at heart, you're going to be second guessing them and really frustrated throughout the process. So their job is to guide you through the rest of it. Now, how many people, show of hands, like to shop? If you like to shop, there we go. Good, some honest folks out there. If you like to shop, this is the fun part, y'all. This is when you get out and make a huge wish list of all the things perfect, of all the things you're looking for in a house. So you're going to make this gigantic list of all these things you want, and then you're going to go out there and shop, and you're going to see a lot of different houses, a lot of different areas, and that's going to help you. That process, let's say you wrote down a list of 100 things. Well, are you guaranteed going to get all 100 of those things? Probably not. Maybe. It's happened before, I'm sure. But what will happen is, as you're shopping, different things will become priorities to you as you're shopping. And so that's really important. And don't forget, this is supposed to be a fun process. We do want you to shop for a house and enjoy it. Make sure you make that wish list. So once you've settled on a house, you and your realtor make an offer, it gets accepted, then you're going to get a home loan. Another word for a home loan is a mortgage. We want folks getting 30-year fixed rate mortgages, and we want you to shop. So one of them you'll hear about in a little bit is the rule of threes, but the rule of threes simply says, I'm going to compare 3 offers when I get them. So I want to interview 3 realtors before I choose one. I want to call 3 mortgage companies before I choose one. Now, I do not have to get my mortgage from the same financial institution that I got pre-approved from. So I have some facilities to shop. And one of the things I will say is probably the biggest mistake we see first-time home buyers make is they don't shop for a mortgage. Well, they bank at ABC Bank, and ABC Bank pre-approved them, and so they go back to ABC Bank to get their mortgage. Well, the problem with that is ABC Bank might have the lowest interest rates in town, or they might have the highest. And unless you shop, I have no idea. So the next step is the home inspection. So this process, y'all, of buying a house is a little odd. Most of the things we do now, you can drive through McDonald's today and purchase a Happy Meal, and you give them the money, they give you the meal, transaction complete. Well, the home buying process doesn't work that way. No money is taking place typically until you get to closing table. That's when everybody gets paid. And by the way, that realtor that you hire, the seller typically pays them, and they get paid at the closing. Same with the bank and the closing attorney. But the one thing you're going to need money for, and is a very straightforward transaction, is the home inspection. So you give them the money, they come out, do the inspection, and their job is not to pass or fail. Hey, this house is great, you should buy it, or no, this house is no good. Their job is to make sure you're really familiar with that house. So they're going to walk you through it. You're going to be there. Should take several hours to go through the entire house and all the systems, right? Not the paint color, but the age of the heating and air conditioning unit. So you know, as a homeowner, if you're buying one that's older, that's going to need to be replaced in the next few years. Things like that. So the home inspector's job is to make sure you understand the house, not to tell you to buy it or not. That's a common misconception. But then you pay them and you're done. You get a report from the home inspector and they are done. Be very leery of any home inspectors that tell you you don't have to be there for the home inspection. That's a real mistake. We want you there. We want you understanding the house. Now, you just are purchasing the biggest thing you're ever going to buy. You need to make sure it's protected. And that's where homeowners insurance comes in. So you want to shop for that as well. Sometimes it makes sense to bundle that with your car. Other times, if you shop, it may be cheaper to get it from 2 different providers. But you never know unless you shop for it. Closing. So this is the day where you sign over all these papers. In Georgia, it takes place in an attorney's office, so you're signing all these things with your hands, and you're reading all this stuff and going through it. But the nice thing is, at the end of the closing, they slide the keys over to you, and you are now a homeowner, and you get to move in. So these are the steps in the home buying process. And like Catherine said, if you have questions as we go through, please type them in the chat box. We will have time at the end to answer them. We'll put them in what we call the parking lot. So we've just looked at the steps. How do we get started? Well, we said getting your spending plan started is the way to go. So what goes into a spending plan? I need to write down my monthly income, my yearly income, which I can easily get from my tax returns. Income hasn't changed. And all my monthly expenses. So I want to know what's going in and what's going out. I also want to write down any debts that I have, and that can be easily attained from annualcreditreport.com. So once we've got our spending plan, or the pieces of a spending plan, the other fun part of this, and Catherine, do we end up putting the SMART goal activity in the chat box?
Yes, so it's going to be in the content, so it's going to be in the shared file location for them, Richard.
Perfect. Thank you so much. So a SMART goal is specific, measurable, actionable, and realistic, and it has a time frame. So what is my specific goal? So what type of house do I want to buy? How many bedrooms, bathrooms? What special features does it have in it? You know, is it an open floor plan? Does it have a garage? You know, what am I looking for in a house? Be very specific about it. Measurable has to do with the amount of money, your own money, you need to set up to purchase a house. So if you need money for down payment, closing costs, moving costs, these are all funds that you might need to save up for. The A is actionable. So what action step can I take next to get me closer? Everybody took one today just by showing up. So do I need to contact CCCS for a one-on-one session where we look at your budget and your credit and talk about affordability with you at no charge? Do I want to pull my credit report? Do I need to do my budget? What's my next step? Am I ready to get pre-approved? So what's my next action step? Realistic. Only you get to decide if your financial goal is realistic. So we want you to look at that. Can I buy a house? Can I do this? Is this realistic for me? And then T in SMART is for the time frame. So typically we want you to look at purchasing a home. If your goal is to buy it in the short term, that would be in the next year. So what do I need to do to get going on my goal? And that can be a fun exercise to go through. And that's why we provided it for you in the chat box. To review your income, I need to know how much money I make, how much money I bring home every month. But also, for the first time ever, we just care about your net income, right, which is your take-home pay. But when you go to get pre-approved, the bank, believe it or not, is going to look at your gross income. So we need to know not only what do we take home, our net every month, but we also need to know our monthly gross income and our yearly gross income. And we need to start saving, right? Do I need to set up a savings account specifically for home ownership? Do I need to stop going out to eat as much? Do I need to start putting money automatically in that savings account? Do I need to stop pulling money out? what is my step to help me increase my savings? You also want to deposit any mattress money, and that really is a funny term for cash, or any other forms of income that are coming in. Because when you go to get pre-approved or approved for the loan, the financial institution has to be able to track where that money came from. And so if you do odd jobs on the side, you want to regularly deposit in that to the bank account, to your bank account, so the financial institution can see the source of that money and those regular deposits and count it as income. A lot of small business owners need to start making sure they have that money going into an account that, again, can be sourced and tracked. Because the rule of thumb from bankers is, what I've heard, if they can't track it, they can't count it. And that's going to affect how much we can borrow. So that part was budgeting. We've got our budget set up. We know how much money we make. We've got our SMART goal sitting in front of us, our action step. We're saving some money. We're ready to go. Now we need to look at our credit report. So the best place to start with credit is the website I've mentioned several times already, annualcreditreport.com. You don't want the first time you sit down with a lender to them show you or talk to you about what's on your credit report. You want to know ahead of time. So that can be something we can do very early in the process and get working on it. You review your credit reports. You dispute any incorrect information. We found that 1 out of 4 people have an error on their credit report. You do not want somebody else's information or incorrect information on your credit report. You've got to get that cleared up early. Keep your credit healthy. What can you do to keep your credit healthy? Well, we went into details in the credit workshop, but just some tips. Recap if you didn't make that one. Keep your balances low, especially on any revolving lines of credit. Credit cards, department store cards, gas credit cards. Work to pay those off and don't carry a balance on them if you can. If you have a balance right now, as you lower that balance, assuming that you keep paying on time, your scores will continue to go up. Pay in full on time every time. If you have any late payments within the most recent 5 months, that's going to tank your score. Anything older than about 2 years that's negative is having very little impact on your score. So the credit scoring model is set up for, what have you done for me lately, right? So we want to get on time, stay on time with any loans that we have. And then we want to go back and pay off the old debts. And again, any questions about budgeting or credit, please put those in the chat box and we will get to them at the end. We have another fun poll question for you. How does the bank decide on the interest rate of my loan or my mortgage? So is it the average of my credit scores? Is it my lowest credit score, my highest credit score, or my middle credit score? So how does the bank decide on the interest rate of my loan? A, B, C, or D? And again, if you're not sure, just guess. Catherine, did the poll open up okay?
It did, and they're a quick group. They're already clicking in for us.
Awesome. I love this group already.
Alrighty, so I'm going to go ahead and show the group their responses. So it looks like we have a pretty good mix. Everybody's either saying average, lowest, or middle. We don't have anyone saying highest, but we definitely have a pretty good mix other than that.
All right. So can I move forward and show the right answer, Catherine?
Go for it.
All right. So you guys would make really good bankers because nobody said highest credit score. If you said middle credit score, that is correct. So let's go through a little bit of detail about that. I want to walk you through a scenario. So what will happen is, and by the way, you may not know this, we talked about it in the credit scoring class, but you could be sitting here today with many different credit scores. And what do I mean by that? Well, if you've ever used Credit Karma, they use what's called a Vantage credit score, but only 10% of lenders use the Vantage score. 90% use the FICO score. And within FICO, there are now 9 different versions. And if a lender uses Experian, they're going to get a different score from Equifax than they are from TransUnion. So people go, oh my gosh, there are so many different credit scores. I'm so confused. What do I do about homeownership? Well, the tips that I just gave you about improving your scores will improve all of your scores if you follow those. But what a lender's going to do is they're going to use a scoring model specifically for home ownership. And I don't want you to get discouraged, but I will tell you, typically that scoring model is lower than if you're using Credit Karma, or even if you come see us at CCCS, our FICO score, we use a different one as well. We use FICO 3. And so you're typically going to get a little bit lower score. And a lot of people go, wait a second, that lender just messed up my score. No. What happened is they're using the home ownership scores. And you've got 3 of them, one from Equifax, one from TransUnion, and one from Experian. And they're going to pull all 3. They are going to throw out your highest score and your lowest score and your middle score. So let me see if I can give you an example here. So if I've got person A, whose credit scores are 620, 660, and 675, and I've got person B, whose scores are 715, 725, and 750. So 2 people that are purchasing a home together. What they're going to do, I want everybody to guess before I move forward. Type in the chat box which score or what score you think the lender will use to make the interest rate borrowing decision on. So everybody take a second. You can either type in 620, 660, 675, 715, 725, or 750, or a combination of those, depending on your understanding. So everybody just take a second. We won't call anybody out if you get it right or wrong. Just curious what your thoughts or what your guess would be based on what you know so far.
Okay, so we have someone saying 660 and 725. We've got someone saying
Okay.
660.
Okay. Great. So y'all, when 2 people purchase a house together, what they're going to do is throw out the higher scores. So the borrower that has the higher scores is not going to be included. And if you said 660, that's correct. So person B, even though they're on the mortgage, they're on the loan, they don't average all the scores. They throw out the person with the highest scores, and whoever the lower borrower is, they take out their highest. So they don't reward you for the highest. They don't punish you for the lowest. They use your middle score. And that's what that borrowing decision is based on. Make sense? I hope so. So I mentioned this earlier, the rule of 3. If you remember nothing else from this workshop, the rule of 3 for home ownership will save you money and stress during this whole process. Remember, you're not the first person to ever purchase a house. Your job is to find people that you want on your home buying team to help you through the process, and your job is to shop. So anytime you're presented with an offer that has to do with your finances and the home buying process, we want you to get quotes from 3 different providers. These are the examples of things you're going to shop for. Now you can get pre-approved from anywhere, but when it's time, when you sign the offer and your realtor presents it to the seller and they agree to it, you get in motion. You shop, and that afternoon you call 3 different lenders and you're trying to find out who's got the lowest interest rate. You tell them right off the bat, I'm shopping. What do you charge? What's your interest rate based on my credit score? And usually the interest rate is going to dictate where you go, meaning the lower the interest rate, the less money you pay over the life of the mortgage. So you want the lowest possible interest rate, but you also want low fees. So they can charge what they call origination fees and lender fees. So let's say you call 3 different lenders and they give you the quotes, and 2 of them have the same interest rate. Let's say the 4%. You're like, well, great. Who do I decide? Your question is, what's your origination fee and your lender fees, and you go with the lower cost one for you. Again, the number 1 mistake we see first-time home buyers do is not shopping for a mortgage. Number 2, interview 3 realtors. If you have somebody that has that purchased the home, ask them, who'd you use? Did you have a good experience? Did you like your realtor? And call and interview 3 of them. If you don't know anybody, look in areas that you're interested in purchasing. And if you see their sign a lot, that means they're probably pretty active in that area. And ask them, hey, do you work with first-time home buyers? Do you work with people in this area? Do you know what's your experience like? If you reach out to them and they take a long time to respond, that's not a great sign. If they're energetic and returning your call and they're active and have experience and work with people that have not done this before, right? First time home buyers, those are the types of traits you want to look for. The home inspector, realtors are really good about providing names of home inspectors, but call 3 of them, interview them. Don't go just on price. You certainly want to know how much they charge because that's going to be an out-of-pocket upfront cost, but you want to go with somebody that really knows houses and does a lot of home inspections, writes up reports, wants you there. Be wary of anybody that says that it's going to be they'll drive by, or you don't have to be there, or your realtor can be there on your behalf. We don't want that. You also don't want somebody that does home inspections, but also works on or fixes houses. That's definitely a conflict of interest, right? Well, these are the problems I see with this house. Now hire me to fix it. You don't want that. So the other thing, insurance, just like you would do with your car insurance, and it can be a good time to shop for your car insurance again, but shop for your homeowner's insurance. Get quotes from 3 folks. And then the closing attorney, the lender has a list of closing attorneys that they'll work with. I want you to call 3 of them and figure out who you feel comfortable with. You're going to want to communicate with that person and let them know it's your first time. Can they send you some documents ahead of time? Can they let you know what's going on and communicate really well with you? So shop around. Sometimes people get overwhelmed when I say, oh, this sounds like a lot of work shopping around. It literally, each one of these things can take you an afternoon, y'all. You can pick up the phone, you can call 3 people and get the best price, who you have a good vibe with, and move on. So don't get overwhelmed with the idea of shopping around. It does not take a lot of time. And these are professionals. They do this all the time and give people quotes that use them and don't use them. So you want to make sure you choose who's on your team. Just because an inspector recommended by the realtor does not mean they're the best person for you. That being said, just because your sister used a realtor does not mean that person's going to be a great click for you as well. So this is our third and final poll question. Who should decide how much you should spend on the house? The bank or the mortgage company? B, the realtor? C, you? Or D, the seller? So who should decide how much you spend on the house that you're purchasing? Catherine, let me know if that poll opened up okay.
It did, and everybody's clicking in. We'll give them just a couple more minutes.
Awesome.
Or seconds,
Thanks,
not minutes, not minutes.
Not minutes. This group is fast. I love it. You guys are quick on the draw.
They are. So we got everybody's come in, and we've got that most people say you, meaning the person purchasing the home, and we have one person saying the bank.
Okay, fair enough. Well, the correct answer, and it looks like most people got it, is you. You should decide on how much you can spend on a house, what you're comfortable with. Don't just rely on the bank, because remember, the bank is not going to make your mortgage payment for you. You are. So we want you to decide how much to spend on a house. So one of the top questions we get from people who join our workshops or come in who are considering buying a house is, how much can I afford? Right? I see that housing affordability is a big issue. I want to know what much can I afford. So I want to walk you through some guidelines of what to look at. And this is not what the bank looks at. This is the home buying suggestion or rule of thumb. Okay, so don't go into a financial institution and use these terms, because they'll say, I don't know what you're talking about. We don't use that. I'll show you what they look at in a second. But you need to think about this in 2 ways. One is the purchase price or the sales price of the house. In other words, if I go on realtor.com and I'm looking up houses and areas I'm interested in, you could see houses from $10,000 to $1 million and everything between. And how do you know what you can afford? Well, that's really important to know, much like buying a car, right? You could go into a car dealer and they say, well, how much do you want to spend? And you go, well, I don't want to spend more than $350 a month. They go, well, we can get you in this car for $350. Now, they might stretch you out for 8 years to pay it off. So you need to know the purchase price and the monthly price. So the way to figure out your purchase price, and I'm going to go through an example in a second, is you want to take your gross yearly income. Easiest way to get that is on your taxes. If your income has not changed from last year, and just pull out a calculator and multiply whatever your income is by 2.5, and that should be your purchase price of your house. Now, if you're looking in Savannah or our area, we are notorious for having lower incomes and higher house prices. I live here so I can say that. I mean, that's the case. So if you look at that number and you go, well, great, Richard, I can afford a shoebox 3 counties over, that's fine. We can bump it up to 3. So you take your household income, multiply it by 3, and if you can find a safe, affordable house where you want to be with the amount of bedrooms and bathrooms that you want in that price range, then stop. So if you can find it at 2.5, great. Stay below that. If you have to go to 3, that's fine. At the most, you can go up to 3.5. But anything over 3.5 starts to get unaffordable for you. And we do not want you to be house poor. If you haven't heard that expression, that means you close on the house, you purchase it, you're all excited, have everybody over, and you can't afford the tea to purchase because you spent all this money on your house. So that's the purchase price. That's the rule of thumb. So we want to stay below max 3.5 times your gross. So that before taxes or benefits come out, yearly, so the annual basis income. But you also want to look at the monthly payment. Most people, this is easier to calculate, right? And we can think about this with our rent even. And you never want to pay more for your housing. When you purchase a house, that's going to include principal, interest, taxes, and insurance. You never want that to be more than 40% of your net or take-home pay. And if you think about it now, you could take your take-home pay every month, multiply it by 0.4, and make sure you're staying below that. If you're not, if you think about it this way, let's say that number is half. So half of your take-home pay is going towards your housing. I don't have to look at the rest of your bills. I know it's going to be a struggle for you every month. Because if you think about your budget as a pie, if your housing is half, it's being a hog. It's taking up too much of your expenses or its share to make life affordable. So obviously the lower the better. If you can do it at 30%, that's great. But we don't want you going more than 40% of your take-home pay. Some people are doing this calculation and going, I'm at 50%, I'm at 47% on my rent. It's time to get a roommate, right? So we definitely want you to lower that monthly payment to below 40% of your take-home pay. I'm going to give you an example here, walking you through the math that we just came up with. This is not a math class, don't worry. We want you to use calculators to figure it out for yourself, but I'm going to give you an example. So this is Alexis. She's buying a house full time. Yeah.
Richard? Sorry,
yeah.
I clicked a button and it's showing your video. Can you share your screen again? I'm so sorry.
Of course. Guys, technology is a
Sorry, I went to
thing.
reshare the files to the main room and apparently it thought I wanted to share it to the screen. So I do.
That is not a problem, Catherine. Let me make sure this works for everybody and we can all see Alexis. Catherine, can everybody see Alexis at this point?
Yes. Yes, I'm so
Awesome.
sorry. I'm going to sit back and stop
That's
touching
okay.
things.
Do I need to go back? Did we lose the last screen or are we okay?
Nope, you're good. I just, right as you clicked, so we're all good.
Awesome. She's not the best in the business for no reason, y'all. Thank you, Catherine. Alexis works full-time and has been in her job for 3 years. And lenders typically are going to want you to be in the same field for 2 years. If you are a student, we'll take that into consideration, y'all. So don't feel like, well, I just graduated from Savannah Tech or I'm going to be graduating. Are they going to count that against me? You know, I've been working. Not necessarily, okay? So she makes $15 an hour, works 40 hours a week, and she brings home $1,000 on the 1st and the 15th. She's been renting a house for about 4 years and sees herself staying in the area for a while. This is important because house prices can go up and down, the economy can go up and down. If you can see yourself living in the area you're in for, let's say, roughly the next 5 years, you should consider home ownership if you want to, if you're ready. If you're not sure about the area you're living in, whether you might meet somebody somewhere else, a job, or you just want to go somewhere else, you may want to rent until you're in a place where you want to be for a while. But Alexis's situation is she's planning on staying where she is for a while and has decided she has a goal of buying a home. She's been working on her credit card or credit for the last year. She's not made any payments on her car or student loans. She's paid off her credit cards, but uses it for gas every month. So she's using a little bit and paying it in full. That's great. And her credit scores are 20, 75, and 750. And we know from earlier, they're going to use the middle score, which is 735. So she's ready to move forward with her home buying, but is not sure what she can afford. Seems like a pretty realistic situation. So let's look at, based on the numbers we just gave you, let's look how it shakes out. So her her gross, so before taxes, yearly income, how does she get there? She gets there by $15 an hour times 40 hours a week times 52 weeks in a year. Her gross income is $31,200. Again, you can save yourself a lot of steps if you look at your taxes from last year if they have not changed. But if we looked at Alexis's taxes, they'd be about $31,200. So the purchase price she's going to take, this is how much she's buying a house for. What can she afford when she's out shopping? She's going to take her gross income, multiply it by 2.5, and that's going to give her $78,000. And at most, she wants to stay below, let's call it $109,200, purchase price of the house. So when she's working with her realtor, she's going to be looking in those price ranges. When she's looking online, that's what she's going to want to try to stay below for the purchase price. Again, if you have questions, please type those in the parking lot. So we know Alexis's situation. We figured out what she can afford on the sales price of the house, but we also want to look at her monthly payment. So we said earlier, she gets paid twice a month, the 1st and the 15th, and she makes $1,000 take home each time. So her net income is $2,000 a month. What she's going to do is multiply that times 0.3. You get 600 and want to stay below this next at or below 40%, so times 0.4, which would be 800. Everybody got that example? Raise your hand if you're still with us and these examples make sense to you. Perfect. I'm hearing some hands going up, some dings. That's great. You guys are such an engaged group. I really appreciate it. So what does the bank look at? We've just talked about the consumer recommendations, but the bank doesn't look at those. So what does the bank look at? And you might hear this expression sometimes, DTI. And it's really funny, y'all. I guarantee if I came wherever you work, that you'd be, if I shadowed you for a day, you'd be using all kinds of acronyms and terms, and I'd go, what's that mean? What's that mean? Well, the banking and the mortgage world is no different. And one of those terms is DTI. And DTI stands for debt to income ratio. Now, before you get like, what does this mean? The nice thing is it's telling you what it means. What it means is the debt that you have compared to the money you make. We dig a little bit deeper. The types of debt we can consider or get into are mortgages, car loans, student loans, truth bomb, credit cards, personal loans, medical bills, collection accounts, rent to own, title loans, finance companies, furniture companies. These are all debts. So it's not our monthly light bill. These are debts that we have and whatever our monthly payment is on those debts compared to our income, how much money we make. And remember what I said earlier, the financial institution is going to look at your gross income. So before taxes or any benefits come out. And what they're doing is just comparing those two amounts. How much debt do you pay out every month compared to how much money do you make every month? That's what the financial institutions are looking at. So they're going to look at your monthly debt expenses, divide it by, again, your gross income, and that gives you a percentage, your debt to income ratio. Now, what are the guidelines we typically see? There are two types. One is the front end ratio. Now, front end has to do with just the mortgage you're considering. So what's your principal, interest, taxes, and insurance compared to your gross income every month? So what's this payment going to be divided by the money you make. So they have certain guidelines there. And depending on the type of loan you're getting, whether it's a VA loan, an FHA loan, a conventional loan, a rural development loan, they might have different ratios or percentages that they're looking at. And they may say, you're good to go. If you look at this amount, you'll be in an amount that we can approve you for. But banks aren't dumb. They're going to minimize their risk. So they know you have potentially other monthly debt obligations, and they're going to consider all those as well. So they're going to put in your student loan payment every month, plus your mortgage payment, plus your car payment, plus your credit card minimum payments, and they're going to divide all that by the amount of money you make every month. Typical ratio on these, this is a general rule of thumb, most loans want you to be below 1% of your front end ratio. So what that means is they don't want your mortgage to be more than roughly a third of your gross income every month, and 43% on the back end ratio. So other debts included with your mortgage, they want you to be less than half, about 43%, as a general rule of thumb there. But again, that depends on the type of loan you're getting. So one of the things you may hear from a lender when you go get it pre-approved is, okay, your credit looks good. And by the way, people often ask, what's a good target credit score for home ownership? We shoot for your middle score to be at 660 and above. Why 660 and above? Because every type of program and type of loan out there at 660 and above, we know credit won't be an obstacle for that person. Now, there are some that'll approve you at lower, but 660 on the middle score means credit won't hold you back. So hey, your credit score looks good, we can approve you on that. Your front end ratio looks good, but your back end ratio is a little higher, so we can't approve you right now. So what does that mean? Well, you really have two options. One, make more money, or two, reduce your debt. And it might be a combination of those two. So if you hear that, don't get discouraged. Just know you got to focus on bringing in or earning more money and reducing the amount of debt you have. And that's what we've got for you today. We did want to open it up for questions. So let's take a second and check, Catherine, if you wouldn't mind checking the chat box, the parking lot, and see if there was anything we did not get to today.
No, but someone did want you to repeat the percentages for front and back end. So I did put it in the chat box, but in case someone can't see the chat box, if you'll go back over the maximum average numbers.
You bet. So as a general rule of thumb, 31% on your front end ratio. So that's about a third of your mortgage payment compared to your gross income. And then the back end is about 43%. So that's on the back end, that's all your debt, including the mortgage, divided by your gross income. Most want those to be below 43%. Good question. Any other questions?
Not at this moment, but we'll give people a couple minutes to come up. There we go.
Perfect.
So it says you briefly mentioned rent to own. How does that compare to traditional home ownership? What are the pros and cons?
Oh, I love this question. Thank you so much. So traditionally, and if you're not familiar with rent to own homes, traditionally that's somebody that is not credit ready, but likes where they're living, and the property management company or landlord says, look, I can do a rent to own contract with you where you will essentially make rent payments, but at a certain point, and it comes out, you'll have a chance to purchase the home, and those payments that you're making are going towards home ownership. So on the surface, that sounds like a pretty good deal because I said credit holds a lot of people back. But the reality is, in those situations, it's a pretty good deal for the landlord or property management company. And what I mean by that, well, they dictate the rent, and the rent typically is going to be higher in a rent to own situation than it is in just a straight rental situation. The other thing is credit does not get repaired or improved overnight. And so you might be working diligently to improve your credit, and that deadline hits for you to buy the house and you're still not quite there. Well, the way that rent to own contract usually reads is that person can now rent or rent to own to somebody else at no obligation to you, and you've been paying more for that. So what we usually suggest is, if you like where you live and you can't afford to purchase it right out, what we suggest is renting, paying the market rate as you can, and then working with us, working with yourself to improve your credit so you can know you can get approved. So we don't usually suggest rent to own. If you are considering it, make sure you get your own attorney to look at that contract and make sure somebody is looking out for your benefit, because usually they're definitely weighted towards the owner of the property at that point. Hope that answers your question. Rent to own is very popular, but usually not the best thing for the renter or potential future owner. Great question. What other questions do we have?
No, but someone says thank you, so they liked it.
Good. Welcome. You're welcome.
We'll give people just a couple more minutes. I guess if you aren't able to put it in the chat box, if you want to raise your hand, I can see if I can unmute you, and you can always ask your question then. Or you can unmute yourself and ask the question down at the bottom.
Perfect. And we are at time, so if anybody needs to hop off or doesn't have questions, make sure you download the information that Catherine put in the chat box. But if you have a question, we're happy to stick around for a few minutes and answer those.
What are good qualifications to look for when choosing a home inspector?
Great question. I think somebody that does it as a profession full time, it's their main job. Any type of licensing that they can have, make sure they're not doing other like I mentioned about repairs. I would say somebody that, again, is willing to have you there to answer your questions, and maybe can send you a sample report ahead of time so you can see what they've done, taking out other names and things, but you can see the type of work they've done before. You really want somebody there that has, I think, a lot of experience, has done a lot of home inspections, and is not trying to sell you. Sometimes they have this homeowner or home insurance for their liability. You don't typically need that, so they're not trying to sell you additional things. Really somebody that you feel comfortable with, that is going to explain. I mean, I don't know about you, but I'm not a very handy person. When I bought a house, I needed a home inspector who was able to take somewhat complicated mechanical and technical issues and explain them to me in a way I could understand. And so if you understand the report that they wrote, or they're talking to you in a way that you can understand, I think that's a really good sign.
Perfect. And then and what I'll do is I'm about to put the 10 important questions to ask your home inspector.
Perfect.
I'll drop that in there so that you have at least 10 important questions. They're the ones that we give everyone that comes and talks to us, so it at least gets you started. And then while I'm doing that, Richard has another question to answer. Yep. What do you think about NACA, N-A-C-A?
Yeah, so let me first say I appreciate you putting the 10 questions in there. The home inspector, that's kind of your cheat sheet. So if you're shopping between 3 home inspectors, just ask them all those 3, and by the end you'll be able to choose the one you're looking for. So thanks, Catherine. NACA, I'm not super familiar with. I know they're now in our community. From what I understand, they're offering very low interest rates with very little credit consideration. I would just be curious what they're using for making the borrowing decision. So me as a buyer, how do you know what I'm going to pay versus somebody next to me? What are you making that decision based on? But we've gotten feedback from clients, but I have not worked with anybody who has gone through their whole process yet. So I'm sorry. Other questions, Catherine? Do we have anybody